We're going to talk about aging and how not to plan for long-term care. I'm here with my business partner, Derek Wilkins. We're also cousins. We're LTC Tree, and we're going to talk about 4 ways you can or cannot plan for your long-term care. Hey, Derek, let's jump right into self-insuring. What are your thoughts on that?
Yeah, self-insuring the long-term care risk, it's a really viable option for a lot of people. So, the long-term care risk right now in today's dollars is about $100,000 per year per person. Now, I realize we got a big country. Some areas might be more, some might be less, but call it $100,000. And the average time people will need long-term care is probably 3 to 6 years on average. So we're looking at about a three hundred to $600,000 risk per person. Now, if you both need it, you could be approaching $1 million, both the husband and wife. But a lot of people, they have assets that they could easily pay that. So our slightly higher net worth clients, we're finding a lot of them are self-insuring the risk just from their own assets. Now, a couple things to think about if you choose to do that is if you need long-term care, say like in another year, like 2022, and the market's down 30%, you might be having to liquidate your stocks at a bottom. And then after you liquidate them, you got to pay capitals and gains taxes. So if you do choose to self-insure the risk, there are some other products that you could allocate some of your money into and get some tax deferred growth on it, as well as getting a shot at getting higher rates of return.
Yeah, I mean,
That would probably
traditionally
help.
people have used bonds for that kind of thing, but I don't think you're talking about bonds.
Yeah, bonds, especially the past 10 years, because they're really tied with that fixed rate market, which has been low up until recently. A lot of people have just bonds have either gone sideways or in some cases down. So there's a product called an equity index annuity with a long-term care rider, essentially what it is. So what that product is you still keep the majority of your money in the stock market. It's growing, doing what it's doing, but you take a piece of your bond portfolio or the money that's in a fixed asset like a CD, allocate it towards this equity index annuity. And these annuity companies, they allow you to index it to a NASDAQ fund, the S&P 500, the Dow Jones, various fund families. But the insurance company will guarantee, hey, if those funds are down that year, you will give you a 0% return. So you get a 0% return in negative years. But the upside is we've seen some of these come in at 12, 13% per year. Now, if you need long-term care, they'll give a 25% bonus to whatever your account had grown to after the fifth year. So there's some more sophisticated products that you could do. If you do want to self-insure, you can self-insure with a guarantee of a baseline and gives you a shot at getting stock market like returns.
Yeah, so that self-insuring is kind of the default for most people. That's number 1 out of 4 that we're going to cover. And I've actually got a bonus if somebody hangs around till the end. Secondly, you can, so let's say that you want to quasi self-insure. In other words, you've got the money to cover long-term care, but you don't want to have to earmark it for long-term care. That's where a hybrid long-term care insurance plan comes in. So let's tell them a little bit about that.
Yeah, what a hybrid long-term care product is, it's also called asset-based long-term care insurance. And the reason it's called asset-based is you take a portion of your assets. 60-year-old would probably take about $100,000 to fund one of these. Now it's a single premium, it's paid off. Now some companies will allow you to pay it over 5 or 10 years, but the net is you'll have about 100,000 per person in this hybrid product. Now, what it gives you 2 buckets of money. You have the first bucket is going to be the life insurance. So ballpark, if you put 100 grand in, maybe your life insurance is worth 130,000. Your kids aren't going to get rich on it, but they'll at least get your what money you put in back, if not a little bit more. The second bucket is going to be the leveraged amount that you can use for long-term care. If you put 100 grand in, it probably starts you off with around $400,000 of long-term care benefits. Now that grows 3% per year compounded. So by the time that 60-year-old is 85, that long-term care bucket will be close to $1 million. Your life insurance stays the same, but the long-term care increases over time. Some of our better companies will pay you that long-term care insurance benefit in cash, so you can spend it however you want.
Yeah, so that's if you have the money and you're thinking about self-insuring, the annuity options, obviously keeping most of it in the market, the hybrid options, peeling off a little piece. What about somebody who doesn't have $100,000 to drop in either over 10 years or one lump sum? That's where traditional policies come in. We've been selling these for a long time. Let's cover those.
Yeah, what a traditional long-term care insurance product is, it's very similar to your auto or your home insurance. You're simply paying an annual premium, and if something happens, and in this case, the something is not your house burns down, but if you need long-term care at a assisted living facility, nursing home, or home health care, you can begin to draw money out of this insurance policy. And the benefit of those is you're not giving the chunk of money to them up front. Now, those plans the premiums, you have to pay those each year for the rest of your life or until you need care. Now, once you need care, they're stopped. Those plans are also subject to being increased. So there's pros and cons with all of this, and we work with both of them. So we're happy to go over the pros and cons of both of them.
One advantage, one pro of the traditional plans that we're going to make a separate video on is they qualify for what are called state partnership programs. We don't want to oversell this feature, but it is a nice benefit that provides some asset protection if you ever need to go on Medicaid in your state. And actually, I'm going to bring in a bonus. This isn't one of our four, but what if planning for old age and aging, what if you just want to rely on the government? That's what a lot of people do.
Yeah, so a lot of people, that's kind of the default answer to a lot of people. And we realize there's so many programs out there. It's hard to keep track with what's the rules and how does it work. How the government works is you could possibly qualify your state's Medicaid system, but to get to qualify, you have to spend your assets down to essentially zero. So if you had $1 million and you want to get on Medicaid, it ain't happening. You're going to go from $1 million to maybe $2,000 they allow you to keep or something like that. But it's then that you're going to be subject to going to a Medicaid nursing home. They're not going to put you in those nice assisted living facilities that are like the Ritz-Carlton. They're putting you in a state Medicaid approved facility. A lot of times those are overcrowded, and it's not really the best option for most of our clients. If you're slightly higher net worth, you're not going to want to go to a Medicaid nursing home. But if you have no other option, then yeah, that's a good safety net.
Yeah, I just think it's if you have the means to cover this, you're not going to be happy with the level of quality in a lot of the Medicaid situations. Ask any physician what their reimbursement rates are for Medicaid compared to private insurance, just in healthcare in general. It's the same with long-term care. You're not the top of the priority list, which you want to be the top priority when you need care, should you need care. So let's get back on the rails here. So you kind of previewed it a little bit. Let's dig a little deeper into the annuities as an option for planning for old age. Annuities tends to have just historically have had sometimes typically negative connotations, but they've really gotten a lot better with the higher interest rates lately. Let's kind of dig into that.
Yeah, and those negative connotations were for good reason, because these are fixed products, meaning that they're not putting your money in, you're not going to lose principal. So it's really subject to that fixed Fed funds rate. And so, 2 years ago, that was 0.5%. Now it's 5.5%. So the insurance companies, it's night and day compared to what benefits they can offer you now. And we've seen a lot of these annuity contracts really up the interest crediting methods, which essentially means how likely are you to earn interest in double digits? And it's much higher than it was. Doesn't mean it's either guarantee you're going to earn a 10% return, but it gives you a shot by giving you higher participation rates, indexed to, again, like the NASDAQ, the Dow, Fidelity, Goldman Sachs, all these different fund families. You can indirectly index your money to those. And how they do it, a lot of people say, oh, this sounds too good to be true. I get to get a 10% return and I don't have any risk. They do it through the options market, which what an option is, it's a right to buy a stock or security at a future specific price in the future. So an example, say you wanted to buy an option in Apple stock, and Apple stock's currently trading at $100. You felt, you know what, I think they can sell a lot of iPhones. So a year from now, I want the option to buy Apple stock at 120. If a year from now, Apple stock price is $150 and you have a right to buy it at 120, you have a line at your door for that right. So that option just went up in value. Conversely, if Apple stock price is $80, who wants the right to buy it at 120? So you just lose the interest that year, which hence a 0% return. That's how they do it. It's not magic. They're indirectly exposing to the markets. And if you need long-term care, that 25% bonus after the 5th year, that's just an added bonus. So
So I have a question for you, and it's just going to be completely candid. Why wouldn't you just buy your own options? What advantage does the insurance company have over, Joe investor playing in the options market?
That's a good question. Yeah, options are probably some of the most sophisticated investment tools really left up for the professionals. And that's what the insurance company, they have all these investment professionals getting in and out. And they also have the law of large numbers. So they're going to these markets buying huge quantities of these investments over time. So, unless you're a sophisticated investor, I'd leave the options market to your financial
But yeah,
professionals.
there's a lot
And
of
in this
ways to
case,
get
insurance,
burned in options markets. The way the
for
premiums change
sure.
and the spreads, if you don't know what you're doing, you can quickly give all your money to the professionals who are out there in the market buying and selling options.
That's
Um,
true.
yeah, so in recap, there's like four major ways with the bonus of government we don't necessarily recommend. Self-insure. That's probably what you're doing right now if you're watching this video. You've got your money, you've got it saved. If you need long-term care, you might have to peel off $100,000 or $200,000 a year in current dollars. The second is buy a hybrid long-term care plan. That allows you to hedge some of your risk into an insurance plan, get leverage on that premium. Don't want to do that? The traditional plan is not a bad way to go. It's got an annual premium, like Derek said, your home or auto. We're all used to paying that kind of thing. And then lastly is the annuities. But really, it's a very personal type of decision. So, what should be the next steps if somebody has no clue what to do?
I'd say there's two things we want to do. The first is have an honest conversation with yourself, evaluate your health.
Yep.
Are you in shape? Or do you exercise? Are you obese? Do you have diabetes? Or how are your joints doing? Did your parents have dementia? Like, really evaluate your health because you know it better than the insurance company. So that's an added advantage you have is what's really going on with your health. And so if you feel like you're in great shape, then yeah, maybe self-insure, get one of these indexed annuities, kind of maybe have as a backup. But if you do have, if you're, starting to feel a little bit, the aches and pains, it might be something it's just sophisticated financial planning. Maybe you don't get a huge long-term care policy, but maybe get something to hedge the risk.
Yeah, and then let's
So
go to the opposite end of the spectrum. Maybe you're
yeah,
in really bad shape through a series of, stress and hard work over your life. You may not qualify for an insurance plan. That's where still the annuities can be an option in addition to just saving your own money. So no matter where you are on the spectrum, whether you're just very healthy, no problems, or all the way to some significant health problems, there is an option that will cover in any case.
yeah. So if you'd like to learn more about all these options we discussed today, we work with every single long-term care company and annuity company out there. We shop the market. That's kind of the DNA of LTC Tree is we work for you, not the insurance companies. So we'll drill down and go over the pros and cons of each product and send them to you on a side-by-side spreadsheet. If you want to get more information on any of these products or just want to run some questions by us, fill in the form on our website. We'd be happy to discuss it with you.
Yep. So we'll wrap up for today. We are going to be releasing another video in about 10 days on the partnership, maybe a little sooner. So if you're looking at traditional plans and the partnership, be looking out for that video, and we'll wrap it up. Talk to you later, Derek.
All right. Thanks, guys.